Hello, welcome back to the continuing lecture in investments. So, our previous example of the portfolio management, right? Of course, we used, quarterly data. So the holding period was 1 year, right, in this example, but the each holding period, each quarter holding period had different returns, but if we average it, it had to be, geometric average, right? And which is, nothing new. We already know that's what we've been dealing with all the time in finance. And I told you also, geometric average is a kind of weighted average, but it's time-weighted average because it ignores. It's mainly, it's focusing on, the compounding effect due to time, but it ignores the quarter-to-quarter variation in funds under management. So in other words, we're not really, the returns are not weighted by the, the amount of money, right? The amount of, funds, and there is a variation. So actually, if in a cross-sectional data, right, in a cross-sectional data set, right, when we usually, the usual case of weighted average factors in the variation in proportion, right? So, but that kind of, proportional variation is not our concern, right, in geometric average, in time-weighted average. But also, if you think about it, the return, normally, the normal case is investors earn larger cumulative return when high returns are earned from larger sums invested, and low returns from less money invested, which is, also, plain, obvious fact. When cumulatively, when you have larger funds invested, right, and when return is higher, of course, the cumulative result in dollars would be greater, right, with more money at risk. In other words, if you play a gamble, to use this kind of, analogy is a bit, could be inappropriate or not quite fitting. But when you're in a winning streak, the problem of most people, getting hooked in gambling or speculative, speculation is um, it's mainly because they think that lucky streak would repeat. And if you have been, it is true, obviously when you have, good fortune of uh, making, 30% return in the first investment in your life. For the so think about it. You get carried away. You think you are a genius. You think you are cut out for investing. And from the first investment ever in your life, the return was 30%. And you would think, wow, and you put only $10,000 into that. And some creepy thinking, um, uh, creeps up. In other words, you would think, well, since I made 30% return with, just $10,000, if only I had $1 million, right? 30% return on $1 million would be $300,000. I would have made, a huge return. I mean, in terms of rate of return, it would still be 30%, but since the invested fund was a lot larger, the dollar return in terms of dollars would have been much bigger. And this is the problem, that gets people, hooked onto gambling. For example, you went to some casino for the first time in your life, and out of pure luck, you hit a jackpot, and made you just put $10 into the slot machine, and out of pure luck, you got $1,000. You hit $1,000, and you think you should just stop there. And some people think that that lucky streak will repeat itself, and keep putting money into that and lose not only their initial seed money, but lose everything, which is usually the case of people who are of the speculators, right? But again, what I'm trying to say is your dollar return depends on how much money is at risk. In other words, how much money you are putting into the game, right? If you put, if the return was 30%, if you had put, only, $10,000, it would be 3,000. But if you had put, $1 million, that would have been 300. So it's obvious, there's nothing, but again, the opposite is also true, right? You have to always keep in mind that if you win, that's positive 30%. If you lose, that's negative 30%, right? Usually the case is the more money you put into play, the bigger return, right? And a smaller the smaller money you put into it, the lower the return in dollars, right? And in our example, in our previous example, but it doesn't always turn that way. In our previous example, was that was the opposite case. In table 5.1, higher returns, 25% and 20% achieved in quarter 2 and quarter 4. The fund managed was 1.2 million and 0.8 million respectively. And the lower returns, negative 20% and 10%, occurred when the fund managed $2 million and $1 million respectively. This was an unfavorable combination. But what I'm saying is, what I said, I mean, rate of return doesn't depend on the amount you invest, right? Rate of return doesn't depend on the amount invested, but the dollar return, what I'm saying is dollar return, of course, depends on return in dollars, right? Depends on the money invested. But in our example, it was an unfavorable combination, right? They had a better return when less money was under management. The published data on past returns by mutual funds actually are, geometric average, time-weighted returns, because the fund manager does not have full control over the amount of assets under management. Yes, it's not entirely, see, because of the net cash flow, right? Net cash inflow, right? Which is not under the control of the fund manager. I mean, it could be partially to their credit. I mean, if more money came in during the quarter, it's partially due to their credit. I mean, if they are, if investors, see the previous quarter's performance and decided to put money, that's partially to the fund manager's credit. But look at the third quarter. In case of third quarter, when investors pulled out 0.8 million from this fund, that wasn't due to the result of the third quarter, because if they lost 20% in the third quarter, that is only known after the third quarter is over. And this pull out of 0.8 million from this fund, and when they pulled out, when the investors pulled out this money, it was before this third quarter return was released, right? They pulled out during the third quarter, and that decision by the investors to pull out money must have, it couldn't have been due to based on the second quarter result or the first quarter result, right? Because in the second quarter they did 25%. First quarter they 10%. I mean, all of these positive results couldn't have contributed to pulling out the money, right? So it's not entirely due to the fund manager's performance, right? I mean, during the third quarter, investors sensed that the third quarter is turning out well, so they took precautionary measure and pulled out the fund. That is more, plausible interpretation. But then that's why, it's not entirely due to the fund manager, right? So it should not weight returns in one period more heavily than those in other periods. In other words, dollar weighted average. It shouldn't be the dollar weighted average, but time weighted average, right? Now, next is the dollar weighted average return. Is the internal rate of return of the project, right? of course, everything is internal rate of return, but uh, in case of a dollar weighted average return, you see the difference between the left hand side and the right hand side. Previously, right? The left hand side and the right hand side. We got it through purely, we found, average, geometric average, really, based on the product of all the quarterly returns, compounded, and it took the nth root, nth radical of that. However, in the dollar weighted average, we are basically, we are only looking at the net cash flow, right? Net cash flow, and the actually, and we find the present value of that net cash flow. In other words, it is, net present value. I'll think about it. I'm going to have to. This is what? This was the initial. Oh, this is really. Oh, the problem. Okay, let me. This is my actually. Instead of mouse, I'm using the touchpad, and it's gonna be kind of difficult. Suppose you move this to the left-hand side. This is 1 million, right? 1 million was already there, at the beginning of the first quarter, right? So this is the initial position of this fund, right? And it doesn't need to be, you move this to the, if you move this to the left-hand side, what does that mean? That is the initial investment, right? Initial investment. Why don't I put it to the left-hand side of the equation? Why do I put it into the right-hand side? Well, you can do it either way, but if you put it to the right-hand side, that means, cash outflows. Cash outflows. Okay? Yeah. You might wonder, I mean, isn't that the cash inflow? From the fund's perspective, yes, it is cash inflow. From the investor's perspective, that's cash outflow, right? From your own pocket goes into the investment instruments. So it's cash outflow from the investor's perspective, right? And also in the at the end of the first quarter, there was additional 0.1 million coming into the this fund. From the fund's perspective, it is cash inflow, but from the investor's perspective, it is cash outflow. That's why it is negative, right? Also in the second quarter, right? From the investor's perspective, it's cash outflow. And when they pulled out, right, at the end of the third quarter, they pulled out 0.8 million from the fund. So it came back to the investor. So it's cash inflow from the investor's perspective. And then so on. Finally, in the fourth quarter, right? 0.96 is the so think about it. From the investor's perspective, investors started with the initial investment of $1 million. All the cash flows, net cash flows in the following 4 quarters are like this, right? So if the present value of all of these net cash flows, right, are equal to 1 million, right? Then this equation is balanced. In other words, all your future cash flows are equal to your present value of all your cash flows are equal to your initial investment, right? Therefore, that present value is 0. I mean, this is like again, this mouse is not working. So let me. Oh, oops. That present value. So this is. Okay, so net present value will be 0. That means that's basically the idea behind compounding and discounting, right? So the dollar-weighted return in this example is less than the time-weighted return of, and if we find the internal rate of return in this case, the dollar-weighted return is less than the time-weighted return of 7.19%. Well, since the portfolio returns were higher when less money was under management. And the difference between the dollar-weighted average versus time-weighted average return in this case is quite large. It's not always the case, but yes, there will be a difference because what each measure focuses on is different. Now, if we calculate, we can use internal rate of return formula, and I have, let me see if I have, Excel set up for this. And I'm going to go back to It's not a difficult thing, but I can quickly set it up. But let me see if I have already set it up. Now, when did I? Oh. Now that we're let me use. Okay, I guess I will have to. Let me just use whatever. Just, did we actually catch this one? We got this one right. So let me just start a new. Immunization convexity. Okay, let me share this file. I'll have to start from the scratch. Stop this and share Excel. Okay. So you must be seeing a blank Excel file just about now. So I'm going to just make some cosmetic changes. I mean, but this is important. Now to use, I have already this set up. I mean, I have a file already in this for internal rate of return, but I can't find it. So I just, I'm just creating a new file. So first of all, I'll have to type in P, and then cash flow. Okay. Let me, so oh, my mouse is acting up. Okay, I barely made it. Underscore. Okay, so the cash the first one was, everything is in million, right? At the initial investment, right, is 1 million. It should be expressed as, cash outflow, because investing is, from the investor's perspective, is cash outflow. And then in the first quarter, there was, 0.1, and then in the second quarter, was it 0.5? And then third quarter, 0.8. And this is, cash inflow. And then, of course, if you at the end of the fourth quarter, if you your, what was that? 9.6. .96, the final position, right? 0.96. What am I doing? 0.96. And calculating, net present value, we already to calculate net present value, right? We will need to have, present values of all of these. That's fine. I mean, we can do it that way, or simply use net present value NPV. This is the built-in function, and I'm going to show you the other way. This is when my mouse is sticky. It's not. Yeah, no, please don't. Okay, there you go. Okay, rate's not given, so I'm gonna have to. Let me do internal rate of return first. Was it this small? This was not right. Okay, let me then, find out the. Let me see. E8. Yeah. If you get, a 0 for net present value, right? Then this internal rate of return is correct. But this is, once again, dollar weighted average, right? I would like to actually, go over this with, by taking the present value of all these cash flows and actually, tracking it from the scratch. But we already out of time, so we'll have to in the next video. Hopefully, we'll have time to do this in the most fundamental way, right? Without using Excel's built-in function. But well, that's it for now, and I will see you. I will see you guys in the next video. Stop.